This video is definitely going to upset a lot of people that love real estate. But in this video, I'm going to mathematically prove real estate is not an asset. It is a liability. And there's just no way I could spin it where I could really see as a viable asset. And this is going to really save people a lot of opportunity cost, a lot of money, and a lot of bad investments. When you ask most people, why does property go up in value? They don't really know the answer. They just say, well, it always goes up. All property goes up. Yeah, you got your home and it's an investment. No, it's not. And if you start to switch your mind to realising that it's a consumption item and not an investment, it's going to help you as an investor. That's the whole point. And stop viewing it as trying to buy suburban homes and rent them out. The money supply gets expanded. Interest rates are low. And what happens? Assets go up in value. That's it. The property didn't grow an extra floor. Your property didn't grow more land on it. It didn't suddenly, the walls and the brickwork turns to gold. It's a static asset. It doesn't go up in value. It depreciates. Put money to the side. The actual physical asset depreciates. Who's the strongest piece of evidence to verify this? The IRS. See, the true alpha, the true investment views are in the boring white papers of the IRS. The IRS literally tell you how long a property lasts before it needs everything repaired in it. They give rental properties 27.5 years. The road, the shrubbery, the fences, the refrigerator, the stove, the carpets, the roof, the brickwork, everything. You need to replace it, fix it. It decays. The IRS are better than most investors at defining what an asset actually is. They legally define your property as something that decays, becomes obsolete and loses value from natural causes. The only part that goes up is the ground underneath it. Notice they do not let you depreciate the ground. The dirt, the land, that's actually the asset. The actual property just goes up because the money supply expands. Now the problem is, what most investors need to understand is the old strategy of buying a property, a suburban property, and getting on the property ladder. They're never going to be able to buy the property they actually want. Look at Monaco, for example. Monaco's increased over the last 20 years by 1,000%. London, 2,000%. Manhattan, 500 to 600%. Notice, look at this. The money supply expanded by 500%. Manhattan average price expanded by 500%. What a coincidence. It has almost matched the money supply exactly. Now, who is buying all these properties? The prime real estate. Who are they? The millionaires, the billionaires. But really, think about it. What are they? They're shareholders. They're shareholders of the same assets. Big tech monopolies. So when the actual engine, which is the Mag 7, when they appreciate, all the shareholders have excess cash and they buy prime real estate. The actual prime real estate is not going up in value. It's not doing anything. It's just a byproduct, a ripple effect of shareholders who have extra money. Whereas the middle class buy their property, hope that it goes up enough that they can sell it and buy another one that's bigger and better. But they physically are not going to get the property they want because they're relying on a static asset. They're just relying on the increase of the money supply. So they're never going to get the actual property they want. Because guess who gets the property that they want? Investors, shareholders. Now I know people are going to say, Chris, I don't care about buying a property in Monaco, New York, London. I just want the best house in my area. Well, I hate to tell you, but that is then technically classed as prime real estate because it's a property other people want. So what's going to happen? It's going to go into a bidding war. And who wins a bidding war? The person with more money. Who has more money? Shareholders have more money. So the hustler who buys, 5 properties to rent out versus the guy that owns the NASDAQ, it's not even a fair fight. The shareholder is going to wipe the floor with the landlord. The landlord holds 4 average wage pegged rental properties. Keyword is wage pegged. Middle class homes are just tied to wages. Who get the money last? The shareholders are standing right next to the money printer. As soon as money's created, it goes straight into prime assets, aka big tech. Remember COVID? $4 trillion was printed into thin air and went straight into the stock market first. Then eventually that money trickles down slowly into the real estate market. But the average home is chained to wages. And what people do is they hope they get a wage rise enough that they can buy the next property. They're taking the longest path. They're putting themselves through the absolute maximum pain when they could stand right next to the printer tomorrow by owning big tech. This is it. This is the game. You're in a race, whether you like it or not. You are in a race, and you can sit in the end of the queue if you want. If you want to be last in the queue, rely entirely on your income and rely on the growth of your suburban property. Yeah, and the prime real estate gets bought by other shareholders. So the person with 4 real estate properties, they appreciate over 5 years versus the NASDAQ holder. The actual net worth of the NASDAQ holder is they've doubled their net worth, and the person who's spent 1,000 hours as a project manager fixing boilers, roofs, painting, decorating, dealing with tenants, dealing with headaches, their net worth's grown to 1.2. They are also in a chain. They have to sell 4 properties. They have to pay realtor fees. They have to pay capital gains taxes. They're in a chain. So guess what happens? It's total humiliation. The shareholder is effectively a cash buyer. They're effectively a cash buyer. They go into their brokerage app and press withdraw margin loan, or they take a Lombard loan, or they get a Swiss bank to just put a charge on the property and they pledge some of their stocks. These are 2 people not even playing the same game. The liquidity is such an advantage, and this person with the NASDAQ doesn't even pay a single penny, a single dollar in capital gains tax because they do not sell it. They borrow against it to buy the property that they actually want. Whereas the real estate investor has taken such a painful path of trying to. They've listened to the noise of the world telling them that, yeah, real estate is the way to go. The IRS have already just told us. You can look at this paper in 30 seconds on Google, in a second. You can just look at this and they tell you exactly what the lifespan is of all the items. Who else is a great example to back what up? The biggest insurers in the world, Zurich Insurance. What do insurance companies not cover? They don't cover wear and tear. None of them cover it because it's a physical reality that's guaranteed to take place. The law of thermodynamics, entropy, corrosion, rust, wet, dry rot, shrinkage, evaporation, dampness, wear and tear, frost, changing water level. They don't cover any of this stuff because they know it's going to happen. These people, their job is to evaluate risk. So the insurance company and the IRS are actually better investors than the majority of real estate investors. The property is a depreciating asset. It just looks like it's going up in value because it's going up in value nominally. Yeah. Compare gold to the average house price. Yeah. You've lost purchasing power. And you're paying, not only have you lost purchasing power, you're then paying capital gains tax for the privilege of playing the game. Can you see why this is two people playing completely different games? The shareholder is obliterating the landlord. The properties don't produce anything, they're static. So you buy a property for $1 million, put down a 20%, you put down 20%, 5% interest rate, that's realistic to the market today for bonds. Yeah, I mean the 30-year bond's 4.8, so add a credit spread, you're easily paying that. And the reality is now shattered in a high interest rate environment like this. Yeah, so the actual yield of a $1 million property, 6%, 5k a month or so. Operating expenses, net operating income, debt service, real cash flow, 2,000. There's no money. There's no money getting made here. There's no money getting made there. Because look, I'm factoring in entropy and capex. It doesn't happen on your schedule. You can own a property for 5 years and then suddenly everything goes wrong with it. Yeah. Or you might want to gamble and do nothing, hold it together with duct tape. And then what happens when you come to sell it is a surveyor comes in and says, there's rot in the roof, there's dampness here, this all needs fixed before we buy it. We're going to take it off the price, so you lose, they shave off all this money off the price, so you lose it one way or another. You can't avoid physics. This is why so many real estate investors never ever calculate for capital expenditure. They're basically saying, we don't care what the IRS says. Yeah, the IRS has probably some of the best actuaries working for them, doing the math, doing the calculations. The insurance companies are the same. But real estate investors say, nah, I know better than them, and I'm going to do it anyway. But look at the opportunity cost. 30 years they liquidate the property. It's grown 6% in line with the money supply. Pay off the debt. Paper equity is 4.9 million. Capital expenditure over 30 years, 812k. Selling friction, realtor fees, lawyer fees, capital gains tax, net realised wealth, 2.8. So the shareholder has obliterated them. Remember, the only reason people made money in property was because they lived through this era of the low interest rates. That's it. So they got rich in nominal terms and they wanted to tell everyone how great it is. And now interest rates are slightly elevated. It's a lot more difficult to actually make money in the real estate. Now, I know people were going to say, well, look, Chris, you chose a property. It's only got a 6% yield. Yeah, 6% yield. This is not any good. We can buy suburban properties and get like a 12% yield. And here's the problem with people that don't understand about yield on investment. There's a law, it's like a physical law of gravity. The higher the yield, no matter what the investment is, I don't care if it's a dividend or a property or a loan, the higher the yield is because there's more risk. It's capitalism giving you your money back before the asset dies. Think about this. Think about a subprime lender. When someone with bad credit score, how much do they pay for their interest rate? 30%. Because the lender knows that it's such a high risk investment, they need to extract as much money from that person before they stop paying. Yeah, so the higher the yield is just an illusion, or the actual capital growth of the asset is terrible. You might look at these properties that are like 50k, 100k, and they've stayed that value forever because they're in such a terrible area that it's so undesirable. They don't even grow with the money supply, and they're getting a high yield, but they're getting zero capital appreciation. The exact same thing happens with a stock that's a high dividend stock. The company is cannibalizing itself to pay you the dividend of 10, 12% because it's high risk. It's all the same. Capitalism is all the same. So the 200k property is just as worse, to be honest. I'm giving these mortgages interest only, by the way. So I'm actually being very favourable. And it's still negligible. Operating management, vacancy, bad debt, operating income, debt service 6%, cash flow $4,800, true economic cash flow negative 12% is a complete mirage. After 30 years, you pay your capital gains, pay your friction fees, net realised wealth 200k. Pathetic investment. This is pathetic. Do you know what I hate most about the real estate investors? They value their time effectively at minimum wage. Because what you end up finding is they do all the work themselves. Yeah, I'll do this myself, I'll do that myself, and they're on the phone dealing with people, dealing with insurance companies. All they don't realise is they're valuing their time just so like a middle class manager, when actually that's not what they are. They should be their capital allocators. You would make far more money sitting quietly in a chair with a spreadsheet or watching educational content like this. It saves you 10 years of bad investment. You know, like just sitting quietly and saying, is this even a good investment? But people just constantly react and constantly need to, follow the crowd. They hear that someone they make all this money from real estate, so they just assume that it's all true and legit, and they just copy it. There is one pro. What's the pro of real estate? I should be fair, right? Let's be fair. You cannot get margin called. Yeah, so your mortgage is cheap debt for 30 years, and the inflation erodes the value of the debt. And a lot of people don't realise this, and they try and overpay their mortgage, and they're actually destroying the only benefit they actually get from the whole game. So you can potentially borrow against the property. However, I have problems with this. There's things I don't like about it. If you borrow against the property, the bank wants you to pay it off before you retire. Often they want capital repayment, or they want some sort of repayment plan. The problem with that is we want to really, if it only really works if it's the property you're going to live in forever, because you die in it and your children get the step up in basis. If it's not going to be the forever home, I don't agree with continuing to borrow against it. I might make another video on that, because it can only work. The buy, borrow, die framework only works really if the asset outperforms the money supply and the cost of the loan. But the only thing that can do that is the stocks can do that. The property can't do it. But if someone already has a stock portfolio, they could use the property as like a sacrificial lamb instead of their actual stock portfolio. So that is something that I'm open to, but I have looked at it and I might make a video on it. The phantom depreciation tax shield. See, the thing is, the IRS are giving you all these write-offs, and people think, look at all this money. Our net profits are going higher because we're doing depreciation. You still have to pay 100% of the repairs, so it's a mirage. Because when the roof breaks on year 8, you have to pay it all, and you lose 10 years of actual true free cash flow. So I don't like that. 1031 exchange, which can be useful, but you're still just going from one depreciating asset to another. Okay, the one true actual benefit to real estate is if you're buying a property in like another country and you're getting location, the geography. If you're getting a property in Monaco or another country, that is a legit reason for it. But you're not actually buying it because the property goes up. Forced savings is just admitting that the person can't invest at all, so they need a capital repayment mortgage to get any wealth. And this channel's not for those people anyway, so I'm not going to go into that too much. Commercial real estate, commercial real estate, okay. Commercial real estate is a lot better because the cost of entry goes to the tenant. But honestly, this only really works for absolute massive family offices who can buy like an Amazon fulfillment centre. Because all you're actually doing is you're becoming a lender to a fragile business. If you're owning a commercial real estate to like a gym or restaurant, these are super fragile businesses, and the chances of them defaulting is very high. So yeah, you're getting a higher cash flow. All you're doing is servicing the debt. The tenant pays for all the entry and the capital expenditure, so it is better than residential. But you need a solid business as the actual client. So I don't see it being worthwhile. You're still going to get the same amount of money you would get from a US Treasury bond. It does work for massive family offices will buy like an Amazon fulfillment center because it's effectively a free... It's better than a Treasury bill because you don't pay any tax. The only reason it works for these family offices that do this is because they can write off all the depreciation. And they don't even pay the depreciation. The client does. So Amazon pay it. And because Amazon or whoever it might be are never going to default, it's a good investment. It's basically a corporate bond, basically a tax-free bond. For 99% of investors, they can't do this because you can't buy unless you can afford. If you can afford a $25 million Amazon fulfillment center and you don't have any other investment options, then yes, that's worthwhile. But if you're buying like a local gym or restaurant, sorry, not buying it but renting to them, high risk businesses, don't like it. I wouldn't touch it. But there you have it. There's just no mathematical way property is, even if it's a prime real estate in Monaco, New York, wherever, it still has depreciation. You still have to fix things. It is a consumption item, and that's nothing wrong with that. Okay, we can't live in the stock market. So accept it for what it is. Everyone knows that their car is a depreciating consumption item. When you actually understand that, it makes you a better investor. Because no one's like, oh, this car's an asset and I'm going to keep buying all these cars. Yeah, it just, opportunity cost is wasted. So real estate is just the same. It's a consumption. And there's nothing wrong with it. Look, if you need a home and you buy a home and you pay the minimum you can pay a month and invest the rest, you become a shareholder, you're structurally a huge advantage over the person who believes real estate's they believe it's a true asset. Yeah. When the money is printed, you want to be standing next to the money printer. Okay? You want to be standing right next to the money printer and you skip everyone else in the queue. This is this is what the academic finance teaches people, the lecturers teach people. The money supply gets increased and it's absorbed by productivity. This is not what really happens. The Cantillon effect completely nullifies this, and the evidence is in all those the real estate we just looked at. The money supply increasing and then productivity reduces the cost of survival. It does not reduce the cost of assets, because why else is a property in London increased by 2,000% and other assets do not increase by that much? So when money is created, it is not distributed equally. The Cantillon effect is complete evidence that this is not the case. This is not the case. This is the retail pacifier. This is to keep people pacified, to tell them, look, as long as productivity is high, all that money gets absorbed by the economy and the costs stay down. That money exists anyway. That you can't change the fact that the money exists. Okay, that's what you cannot change. You cannot change it. There was $286 billion in 1959. Today there's 22 trillion. If Apple issued 7% more shares every single year, there's no method they could say to you that, oh, that's not actually affecting you. Yeah, they're issuing shares more and more, and they're gaslighting the shareholders to say, well, if the economy absorbs it, then it's okay. It's not okay. M2 is the cost of power. CPI is the cost of survival. That's why London, Manhattan and Monaco are unaffordable for the average person. That's why gold is unaffordable. Yeah, it's the money goes into the assets that people want first, aka the stock market. So instead of investing in assets that do not stand in front of the printer, stand in front of the printer. Big tech monopolies. This can be individual stocks, growth ETFs, the biggest companies in the world dominate. They make up all the gains of the market. So there you have it. Real estate is a liability.